Hi everyone, welcome back to Corporate Decoder. Today we're diving into NeoVolta's latest financial report, and let me tell you, it's a bit of a roller coaster. Think of it like this: they're trying to build a solar-powered house on a windy day. It might look good, but will it stand? We will get to that later, but before we start, if you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below where we can talk about all things business. Scroll tabletop scroll. So what's the big picture? NeoVolta, a company making energy storage systems, released their quarterly report. The main story? Revenue is up, but so are their losses. It's a tale of growth versus expenses, and we're here to break it all down. This report covers the period ending March 31, 2025. It's a look under the hood at how NeoVolta is performing. Are they making progress, or are they burning cash too quickly? Let's get started. NeoVolta is publicly traded and it is considered a non-accelerated filler. This basically means the company has less than $75 million in public float. It is also considered a smaller reporting company and emerging growth company, which means that it doesn't have to follow the same rules as bigger, more mature companies. As of May 9, 2025, there were about 34.1 million shares of common stock outstanding. This number is important for calculating earnings per share, which tells us how profitable the company is on a per share basis. A quick note, this report contains forward-looking statements, which are basically predictions about the future. These statements come with risks, and the company warns not to rely too much on them. Always remember that things can change. Now let's get into the numbers. The first thing is the balance sheet. This is a snapshot of what the company owns assets and what it owes liabilities at a specific point in time. On the assets side, we see that accounts receivable increased from about $1.8 million in June of 2024 to $2,003 million in March of 2025. This could mean that the company is making more sales, but also having a slightly harder time collecting payments. Inventory also went up from $1.7 million to $2.2 million. This suggests the company is stocking up, maybe anticipating more sales. Cash, however, took a hit. It decreased from about $986,000 to $5,000. This drop in cash is something to watch, as it indicates that the company is spending more money than it's bringing in. On the liability side, short-term notes payable jumped from $0 to $1.4 million. This means the company is borrowing more money to fund its operations. There's also a payable to a line of credit lender of about $383,000, which was $0 before. That is more debt that wasn't there previously. Finally, total stockholders' equity decreased from $4.5 million to $3.8 million. This means the company's overall net worth has declined. Moving on to the statements of operations, also known as the income statement, this shows how much money the company made and spent over a period. Revenues increased from $23,000 to over $2 million for the 3 months ended in March. This shows the company is growing its sales, but is it profitable growth? Cost of goods sold also increased significantly, meaning it costs more to make those sales. The gross profit increased, but operating expenses soared. General and administrative expenses, which include things like salaries and office costs, went up dramatically, mainly due to new hires, including a chief executive officer and associated costs like marketing and travel. The loss from operations widened, meaning the company is losing more money from its core business activities. Net loss increased from $589,000 to $1.4 million. This indicates that while revenue is growing, the company is still struggling to become profitable. Now let's look at the cash flow statement. This shows how cash is moving in and out of the company. The net loss was about $3.3 million versus $1.5 million. This is not a good trend. The company did have some help from what is called stock-based compensation, which is essentially free money from stock options and stock grants. Accounts receivable also decreased, which means the company is collecting money from its customers slower. The key number here is net cash flows used in operating activities. It was negative $3.5 million, much worse than the negative $988,000 from last year. This means the company is burning through cash to keep the lights on. To offset the cash burn, the company got about $3 million in financing, primarily from a private equity offering. Overall, cash decreased by around $450,000 from about $986,000 to about $535,000. In terms of accounting policies, inventory is valued at the lower of cost or net value, and revenue is recognized when the goods are transferred to the customer. This is all standard stuff. A concerning detail is that two dealers represented 48% and 15% of revenues. This means that if NeoVolta lost those two dealers, their revenue could drop drastically. It's worth noting that the financial statements were made assuming NeoVolta can pay their debts and that they are operating as a going concern. The company obtained a line of credit of $5 million in September of 2024, as well as short-term borrowings to finance customer shipments. It is all debt that has to be paid, so let's see how they'll get there. During February of 2025, the company issued more stock for over $1 million. The underwriters also have been granted warrants, which are options to buy even more shares. The key point here is the company is issuing more shares and diluting the ownership of current investors. We see that in 2024 and 2025, the company issued significant stock grants that vested over a few years, which essentially means they gave themselves free money and diluted more shares. The company is also issuing shares to key employees and diluting even more. One key risk here is that NeoVolta depends on just two component vendors in China for batteries and inverters. If something goes wrong with those suppliers, it could disrupt the whole business. Also, tariffs could hurt the company's profit margins. So after going through this report, here's my take. NeoVolta is in a tough spot. Revenue growth is good, but it's coming at a high cost. They're burning through cash, relying on debt, and diluting shareholders with more stock issuances. They depend on a small number of dealers and Chinese suppliers, which adds risk. They need to cut costs, diversify their supply chain, and become profitable soon. However, demand is rising, new sales channels were opened, and the company managed to get new financing. If managed well, and if they can start creating real demand for NeoVolta products, they will be positioned in the future in what could be a lucrative industry. Alright, that's our breakdown of NeoVolta's latest filing. What's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.